Good morning, everybody. Welcome to Coffee Talk with Vicky. I hope you grabbed your cup of coffee here and you're ready to join us with Nick Principe he's a branch manager at Princeton Mortgage. And what Nick's going to talk about today is how home buyers can purchase a property with a lower interest rate. I'm going to let him talk about this, but first, Nick, I want to tell us a little bit about yourself, and then we can dive deep into this. If you have any questions, we'll try to answer them at the end of the stream. And here you go, Nick. The floor is yours.
Thank you. Appreciate having me. So my name is Nick Principe. I am with I run the branch over here for Princeton Mortgage. Office is located in Cranston. We got a good group of people over here. We're doing some nice things to try to shake up the mortgage market around us, and just trying to provide value to the realtors that we work with by educating them on programs and of course getting their loans to the closing table quickly.
That's awesome. As Nick's going to talk about today is how we had a little back feed there. So, how does this program work? That you can buy your. I mean, I'm going to let you explain it because it's this is not my realm, but I understand that you can purchase a property and kind of work it where you can get a lower interest rate. Am I correct?
Yeah. So it's there's two programs. They're in essence one and the same. We have what's called a 2-1 buy down, and we have what's called a 1-0 buy down. Same concept. It's just one is, a reduced interest rate for 2 years. One is a reduced interest rate for 1 year. So I'm going to share my screen quick so you can kind of visualize it of sorts. All right. Can you see that?
I cannot see it.
Okay. Well,
Facebook's a little funny with they're changing their algorithms and everything. So if people are commenting, we might not see it. I think we can see your screen. Yep. There it is.
That works. All right. So kind of what we'll go through, what is a 2-1 buy down, who the interest parties are and what their involvement with the transaction is, what are the benefits of the 2-1 buy down, and we'll go through a scenario of it and kind of give you an idea, should you lower the price of a house or take the credit. So 2-1 buy down, it's from Princeton Mortgage. It allows an interested party to temporarily buy down an interest rate by 2% for the first year, 1% for the second year. After the second year, so year 3 through 30, the interest rate is fixed. So for example, let's just say the rate today is 7%. On the first year, the rate will be 5%. And on the second year, it'll be 6%. Year 3 through 30, it is 7%. And then who is the interested party that I've been alluding to? So an interested party is someone involved in the transaction that can contribute towards the cost of this buy down. In this case, it would be a seller or builder, which are kind of one and the same, or the realtors. It's a good way to, on the selling side, to market a property that's been stagnant, and you can, offer this credit towards this versus dropping the price. So something to keep in mind as you are, having those conversations with your sellers, up front when you go to list the house, and then also if it's been sitting for a bit, when you're thinking of a price reduction. Now, what are the benefits of the 2-1 buy down? So what it does is it allows the home buyer to purchase a new home with a more affordable payment, and it gives them 2 years to make lower mortgage payments and gradually ease into what would be that full payment. Alternatively, the buyer can make those full payments for the first 2 years and apply the extra money towards principal, helping them gain equity and build some wealth within their home. Or they could just put money into savings. In either sense, it allows buyers to have some more flexibility with their money on a monthly basis. And we'll just skip through this. We'll go through a scenario of what exactly a 2-1 buy down looks like. So in this instance, we'll use a $500,000 home with a 20% down payment, which gives us a loan amount of $400,000. So in that scenario, that's going to give us a principal and interest payment of $2,661 per month. So again, $500 purchase price, 20% down payment, $400,000 loan, 7% rate gives us a $2,661 principal and interest payment. So that same house, let's just say after inspections, the buyer says, hey, I want XYZ fixed. And you have the option to, request a $10,000 price reduction from the seller or a $10,000 credit. So If you were to go with the price reduction, now we're at a 490 purchase price, same 20% down payment, same 7% rate. That drops the principal and interest payment to 2,607. So that's only a difference of $54 per month versus the $500,000 purchase price. Alternatively, what you can do is take that $10,000 and apply it towards your 2-1 buy down credit, and it's going to give you significant savings over the first 2 years. So same purchase price of $500,000. The seller has agreed to give you 10, which is going to go in the form of almost like a closing cost credit, and then you'll still have that 20% down payment, $400,000 loan amount. So in comparison to that $10,000 price reduction, with the interest rate being 2% lower for the first year, that's going to give you a principal and interest payment of $2,147, which is a $460 per month savings versus that $10,000 price reduction on the left. For the second year, the principal and interest payment will be $2,398 per month at a 6% rate, and that's going to save you $209 per month versus that same scenario on the left. Year 3 going forward, the payment goes to $2,661, which is the same as what it was on that previous slide. So you could see there's significant savings the first 2 years there versus just going this route versus taking a $10,000 credit. Now, this is a scenario where it's like after inspections, you can go into a property requesting this off the bat, and you would present that like you really would any other seller credit. The way you calculate what that amount is, you take the interest savings versus the 7% rate, and then you take the interest savings at the 5% and the 6%, and that's what you get. So in this scenario, $460 a month at the 5% rate saves you $460 per month, and that gives us $5,520 for the first year. If you take that $209 savings for the second year, that gives us $2,508 savings. So you combine the two of those, and it gives you a total cost of $8,028. So $8,028 in interest savings over the first 2 years. If you're requesting a $10,000 credit, that gives you an extra, we'll call it $2,000 to apply towards your traditional closing costs. So it allows you to kind of use the same amount of money, just manipulate it differently to make it more appealing on the buying side. In all likelihood, rates are going to decrease within the next 2 years. So if that does happen, the buyer can refinance before it goes back up to the 6 or the 7%, whenever that option presents itself. And, in the meantime, you save quite a bit of money.
That's a great opportunity, especially for buyers that are like getting kind of knocked out of the buyer pool because of the rates that went up. And it's a great opportunity for sellers their houses are sitting now, they're not selling as quick as they were. And it's a good incentive to sell your house, and what happens, Nick, is you add it to the purchase price. So just like a closing cost credit, it would just be added to the purchase price and then kicked back at the closing, correct?
Right. I mean, it's not added to the purchase price necessarily. It's kind of built in, but you would present it like you would any other closing cost credit or seller concession.
So
So
say, for instance, if the house was you're offering 400,000 and they need a $10,000 credit, we would bring it up to 410,000, and then that 10,000 you would do your magic with it to bring the rate down.
correct. So the seller is still netting their 400. You're getting the savings. So it kind of works out for everybody. Or same scenario, you could offer 400 with a $10,000 credit. Seller nets 390. Whatever works out best for the given situation.
That's a great opportunity. If buyers are out there right now, or sellers, this is really huge. And with the market shifting so quickly, this is a great opportunity. I appreciate you bringing this to our attention. I'm going to stop interrupting you and let you finish.
So it's this is how you kind of would present it on the buying side. Alternatively, we do have that 1-0 buy down I mentioned. Same exact concept, except for the reduced interest rate is only for year 1. So on the 2-1, year 1 it's 2% less. Year 2 it's 1% less. 3 through 30 it's fixed. On the 1-0, year 1 it would be 1% less, and then 2 through 30 it's fixed. So We'll use the same example, $500,000 purchase price, 20% down payment. If the rate is 7% today, the first year the rate will be 6%, which saves you $209 per month. And then years 2 through 30 would be the payment at the 7% rate. That in some scenarios can be an easier ask from the seller because the cost to do it is going to be a fair amount less. So the same exact scenario, if we're doing a 1-0 buy down, you would take that $209 times 12. That gives us $2,508 in cost, and that's the credit you would have to request from the seller. So depending on how much wiggle room you have with the seller, purchase price and credits and all that, might dictate which direction you go with that.
So a good rule of thumb is before they do anybody does anything to put an offer in, they should really talk to their loan officer, which hopefully is you, and get the breakdown before they so they know what kind of credit that they need. Correct?
Right. Yeah. So I mean, before they even submit an offer, you want to be everybody on the same page to say, hey, this is how much you're going to need out of pocket. This is what your payment's going to be. That way there's no questions as you go throughout the process. So we try to do all of that at the pre-approval stage before they even step foot in a house, and then kind of dive back into it as they're submitting offers. So that way there are no, questions as to what's going on or any surprise fees.
That's really great. Anybody have any questions so far? I see there's a few people watching here. If not, we'll just keep going.
Right. So we kind of been talking about how you would present it as a buyer's agent. If you were a seller's agent and your house is stagnant, it's $500,000 house and it's been sitting there for 30 days and you had minimal interest in it. Typically, you're going to start having that discussion with your seller for a price reduction. So instead of dropping the price, let's say 30,000, 20,000, whatever that number is, or even 10,000, you can put in the listing notes to say like, hey, seller is willing to offer credit towards 2-1 buy down, and you kind of figure out what that cost would be. So it can be a marketing tool on both the selling and the listing side. You just want to check with your local real estate requirements for whatever state you're in as to what is allowed to be put into the listing, either publicly or in the listing notes. Some states allow it, some don't, but typically the listing notes is where you can kind of put this in. Now, one of the reasons why we're trying to educate on this program is because if something like this goes in the listing notes and nobody knows what it is, then it's of no benefit. So that's why we're trying to get the word out there on this particular program.
This is really a game changer. I really suggest for realtors out there to learn this. I find a lot of times, no matter how many times you explain closing cost credits, nobody really understands it till it comes down to the nitty gritty, and then they still don't understand it. And I find that with realtors, and I find that with sellers, and I find that with buyers as well. So I really suggest to really learn this, know it, and talk to Nick further about it if you want to get a little bit more deeper into it. But you got to be very, like Nick said, you have to make sure it's worded correctly in the purchase and sales agreement. I personally like clean purchase sales agreements. I can't stand a ton of addendums and stuff like that. So I'd rather get it right the first time than going back and forth and changing it.
Yeah. So one of the biggest questions I typically get asked on this is like, let's say, this same scenario with the 2-1 buy down, the credit to do it is $8,028. Let's say 1 year from now, rates are at 5% and the buyer wants to refinance. What happens with that extra money that was paid towards that buy down? So when the loan is funded, and that's essentially the cost of that buy down goes into an escrow account, and each month a portion of it is distributed towards the loan to pay the difference in what the interest is. So if you're refinancing before the full 24 months is up, that whatever remaining balance gets applied towards your loan as a principal reduction. So your payoff on that mortgage will be less, which in turn means it almost kind of like you got the house for a little bit less. So the money doesn't just like disappear and go away if you refinance before the 2 years is up. It's always there. You'll get it one way or another, either through a principal reduction or if you ride out the full 24 months within the loan. And same thing for the 1-0 buy down if you refinance before 12 months is up. Good chance for in both scenarios where that could happen, where there's a refinance opportunity within the first year or two. So, you don't have to worry about that just disappearing.
So whatever, if you do refinance, whatever remains, you have the option to put it on the principal, correct?
Yeah, it's not an option. It's just
Oh,
automatically.
this goes right on.
Yeah. So if your loan balance is 400,000 and you have $4,000 sitting in there, your payoff is now 396,000.
Okay, that's good.
Yeah.
That's good.
Yeah, I mean, overall, great product. It doesn't increase purchase power because the buyer is still qualified off the higher rate, which in this case would be the 7%, but it does help affordability. A lot of what I'm seeing right now is people qualify for this house at 500,000, but they don't like the payment. So they're backing out. This gives them the opportunity to get them the payment that they want for at least 2 years. And then, in the back of their heads, they know that year 3, it will increase. Most people are under the belief that rates will decrease between now and then. But, so long as everybody's on the same page, like that is a possibility where you might not be able to refinance. Then, there's no headaches down the road. But it's increasing affordability for a lot of people, but not purchasing power.
Now, when say that buyer is approved for $500,000 and they have to add the credit to get the buy down, does that affect what they could actually purchase? Do they have to look at a $490,000 house, or can they still go for that $500,000 house?
So, I mean, what they're approved for is all based off of, pretend the credit doesn't exist, right? It's just, hey, do you qualify for this house at 7% or do you not? And then however that credit is worked in is just kind of how it makes sense. But like if 500 is their absolute cap in this scenario, they couldn't go to 510 with a 10K credit. They'd have to go 500 with a 10,000 credit, netting the seller 490. So it goes by traditional approval methods. It doesn't have any impact to that.
And I'm a firm believer, when you're looking for a home and say you're approved at 500,000, don't look at $500,000 homes, because then you have no negotiation power. If you have to go up, if there's multiple offers, look a little under so you do have that negotiation. I see this all the time. Or people look at homes at 550 and think they're going to chew it down. Like, look a little bit beneath what you're approved at so you have some wiggle room.
Right.
So, what do you suggest, Nick, for a home buyer to do to prepare to get prepared to purchase a home and to get into this program?
First thing I want to do is talk to a loan officer. One, see if they qualify for this program, and then go through the pre-approval process. Make sure your credit's where it needs to be, get the documents verified, income, assets, all that good stuff. Have a solid pre-approval. And then from there, it's just a matter of finding a house that fits within that bucket of your pre-approval.
I have a question. Like, Credit Karma to you is like Zillow to us.
Yes.
And like, we as realtors, we can't stand when our buyers go to Zillow for looking for information, because the MLS is the accurate information. And I know loan officers can't stand Credit Karma because it's like, and it's nothing wrong with any of those entities at all. That's a disclaimer. But you got to do your own. You got to listen to the professionals that are in the field to help you. Tell people why that's not a good route to go. People base their credit on that, and I know why, but I'm going to let you tell people why.
Yeah, I mean, Credit Karma is a good tool for credit monitoring. Like make sure there's not accounts being opened in your name, or there's inaccurate late payments being recorded, stuff like that. But it's not an accurate depiction of what your score actually is going to be. Whatever you're seeing on Credit Karma, when I pull your score, it's going to be higher or lower. Reason being, Credit Karma uses a different scoring model than what we use in the mortgage world. They use what's called Vantage scoring. In the mortgage world, we use another model of FICO scoring. So off the bat, it's two different algorithms that the bureaus are looking at. So if you see a 700 on Credit Karma, we might see a 750. We also might see a 650. We don't know until we pull it. And same thing, each type of credit you go to apply for uses a different scoring algorithm. So whether you're applying for a mortgage, a car, personal loan, credit card, you're going to have different scores between all different types of credit. So that's why you don't want to be looking at homes assuming you'll qualify because Credit Karma says you're pre-qualified for something based off of their credit score, because it could be drastically different than what it is we're seeing.
Yeah, no, I get that all the time when I speak with buyers. They go into Credit Karma and they're saying, "Oh, my score is this." It says it's a different algorithm that mortgage brokers use than Credit Karma. That's like for credit cards, and it's just completely different. And you got to talk to the professionals in the field. I mean, I always tell people when they're buying or selling a home, everybody is going to be a real estate agent and a loan officer. They're going to give you all a ton of opinions. Everybody's going to have opinions on their experience. And you know what? Every experience is different because each person has their own credit scenario. Each home is different. So you can't compare to what other people do. And especially mom and dad who bought their homes 25, 40 years ago. It was a different market. Even last year, it was a different market. You can't compare it. Your friend might have had a horrible experience, but they also might have had like a lot of debt, and they're not telling you the truth of all the paperwork they had to give in to clear it up. I mean, Nick, you see this all the time as well. I just think people, you're only as good as your team, right? You're only as good as the team
Right.
behind you. Trust in your team and make sure you pick somebody that's experienced and knows what they're doing. What do you have to say about that?
Yeah, it's accurate. I mean, everyone's like you said, everyone's going to be a realtor all of a sudden. Everyone's going to be a loan officer all of a sudden. Um, try not to listen to the outside influences. If someone's doing it as a career, there's a reason for it. They have to be at least halfway decent to be surviving in this market. So stick with the professionals. There's a reason why people do it and don't do it. So you're better off just taking their advice.
Yeah, I mean, experience really counts in this kind of market conditions, I believe. Um, there are some newer people out there. They're very well trained, and that's all good. But make sure who you use is very well versed in the products that you're looking for to purchase a home, and your realtor as well. You want to make sure that they know how to negotiate, how to look at home inspections. There's a lot of stuff it's involved, and there's a lot of stuff buyers and sellers don't realize what happens between the loan officer, the realtor, and the attorney, and all those conversations that happen behind the scenes that we kind of keep you guys away from it because we want it to be as pleasant as an experience as possible. So we try to like take that pressure off of your back as much as we can. And sometimes things have to come out because things can't be settled. But you got to really trust in the team behind you because you're only as good as the team
Right.
that's helping you.
Yeah, I mean, we do make a big effort to, we actually call it, to provide an effortless mortgage. And we put our money where our mouth is, where if a borrower is not happy for any reason with their mortgage experience, we will give them $1,000 towards their closing costs. We offer that to them 3 times throughout the process, and it's pretty much an email that goes out from our CEO, Rich Wydell, and it says, "Hey, here at Princeton Mortgage, we know typically applying for a mortgage sucks. So in order to combat that, we developed what's called the effortless mortgage. And in essence, what that means is we are committed to providing a top-notch level of service to you. And if for whatever reason we don't provide that to you, click here to talk to us, or click here to cash in on the Princeton Promise." And the Princeton Promise means if we have not given you what you feel is an effortless mortgage, we will give you $1,000 towards your closing costs. So
That's pretty good.
that email goes out 3 times during the process, pretty much beginning, middle, and end. If they click that link, no questions asked, they get $1,000 towards their closing costs. To put it in perspective as to how often that's taken by a borrower that we work with. Year to date, our office has closed 100 loans, give or take, and not a single person has even requested that. So
That's really good.
yeah, so we really do strive to give people a great experience on the mortgage side.
That's really good. Now, when somebody is coming to see you and to apply for a mortgage, what's the paperwork that they should have ready for you, just to be prepared?
They should not worry about paperwork until we have an application in.
Mm.
Everybody's scenario is going to be different. So somebody might need tax returns, somebody might only need W-2s. Some people we might not even need any of that. So I tell people, don't worry about the paperwork. Let's take it one step at a time. We will, we'll get the application in. I'll review it. I'll let you know what exactly is needed. But there's a lot of companies now that have, allow us to verify stuff online, where sometimes honestly, all I need from somebody is a driver's license, and then we get them in the house. We can verify their bank, their assets online, their income online, and so all we need is a driver's license. Make sure you are who you say you are.
Wow, that's good. Now,
Yeah.
what's the difference between a pre-approval and a pre-qualification?
Pre-qualification pretty much means I pulled your credit and you tell me what your income is, and I believe you, and I say, yeah, you're good to go. We don't do those over here because they're not worth the paper they're written on. Pre-approval means we've actually gone in depth, reviewed all the documents, and said, hey, this is exactly what your income is. We verified it with your employer. We got your assets. We got the bank statements, and then we say, here we go. You are qualified for this, and that's it. Go out there and find a home that fits within that. Another thing we do, it's called the Princeton Advantage, where we can get your file fully underwritten, where basically all it is, we're waiting on an appraisal and title work on the house, and we say, hey, if Princeton Mortgage, if we don't close on this loan because we overlook something or miss something, we'll give the seller $5,000. So
Wow, that's
again, so we put our money where our mouth is on to both the buyers if they're not enjoying the experience, and then both the sellers if they, if we drop the ball. And again, same thing, that has never been paid out.
that's really a good. I mean, you can't lose. It's a win-win no matter what.
Exactly.
It is. This is really a lot of great information. Now, if anybody wanted to reach out to you and contact you to talk to you further about this, or if they're looking to get a mortgage, or if there's some realtors out there that want to talk to Nick about this program, how would they contact you?
You can just give me a call or text. My phone number is 401-862-5110. It's on the screen here, 401-862-5110. Or you could shoot me an email, nprincipe@princetonmortgage.com.
I have to say, I've worked with Nick and he does an excellent job. And I know some other realtors that work with him, and all I hear is raving reviews. So he's good at what he does. And I appreciate your time, Nick. It's been really informative. I know it's a lot to fit into a short amount of time. So again, if anybody has any questions about it, reach out to either myself. If you can't reach Nick, I'll get him in touch with you, or Nick. And if you're looking to buy a home, I'm more than happy to help you. And Nick's more than happy to help you with the mortgage. So if you want to reach me, call me at 401-432-4129, or you can DM me on Facebook and I'll get to you. And if you can't get Nick, I'll DM him and get him to you as well. So I appreciate your time, Nick. It's been great. And I'll see you out in the field.
Thank you. I appreciate it. Good to be here.
Thank you.